Hey guys, welcome. It's good to be back. Good to see you guys. We had an exciting couple of days in the market. We had a lot of volatility with the CPI report, with the FOMC minutes, a little bit because of the PPI today. But really, if we look at the last couple of days, we didn't really go anywhere in our major indices. We're really just sideways. We'll take a look a little at that in a little bit further detail, but other things that we really want to note is the dollar. We'll start with the dollar. We noted that we broke above this downward sloping trend. It appeared that we were forming a new uptrend. And now we can confirm that we have this new uptrend happening because we have a series of higher lows, 1, 2, 3, and a series of higher highs, 1, 2, 3. So it's pretty clear that we are now in a new upward trend in the dollar. And you can see that this high, or where we closed today, is above this high right here. So we broke above a flat top breakout or flat top resistance. And so we have that breakout as well. So we can probably expect that the dollar is going to continue to be strong. If the dollar is strong, that helps inflation a little bit. It means your US dollars is capable of buying more goods. However, it's really interesting that things like DBA, the agricultural fund, is just skyrocketing. It's just been on this monster trend upwards. So does agricultural prices move up faster, or does the US dollar, the value of the US dollar, move up faster? So far, the agriculture is winning out. And so we can probably expect things like food and groceries to become more expensive. And if we look at oil has been doing something similar. So food and energy, the things that the government likes to remove when they report on inflation, those things are going up. But the overall CPI, maybe not as much, although in the last two prints for the CPI, they have been going up as well. So it's putting the government and the Fed in this kind of hard place because they were saying that it's coming down, we're doing a good job. Lately, the Fed has been doing a good job of saying, hey, we really need to see the data. We really need to see it move and stick. And it hasn't been sticking. And so they've been indicating that perhaps they're going to wait longer and longer. And then the bond market hasn't really been responding. The bond market was reacting as if we're going to get our lower rates imminently. And so it's been holding up, but recently, over the last couple of days, we've seen this breakdown. So finally getting the message that, hey, maybe not. Maybe we're not going to get a rate cut. Maybe we're only going to get one rate cut. There was some news about even Joe Biden was commenting, oh, we're going to get it for sure. And so things are getting really political on the US interest rates front, but we're not going to concern ourselves with that too much. We're just going to watch and see how it develops. It is a very good indicator, though, that the markets are not as efficient as academics like to claim. They like to say, hey, we have the efficient market theory. Everything that is known gets priced in immediately. Well, the Fed has been telling us for quite some time, and I've been saying it for a lot longer than the Fed has been saying it, that we're probably not going to get very many rate cuts. So we're going to get one at the most. And the probability of the rate cut in June, we said in January, they had it priced at like 80, 90% likelihood that we are going to get a rate cut in January. I told you guys it was probably more like a 10%. Then we moved on to March, and I said the same thing, probably like a 10%. And we had 70, 60, 70%. Now we've got to July. I told you guys it's probably somewhere between like 20, 30%, 10%. And we had in the 70s and 80s until yesterday. Finally, it looks like we're down here at the 27%, which is more reasonable. But given the new information that we have on the CPI and the PPI, it really should be closer down to maybe 10%. So we'll see how much more this has to go. But what we can see is that this bounced back up today. Actually, yesterday we were down at 16.5%. Today we're at 27.5%. So maybe the market's still not getting the message, but at least with that CPI report, we went down from 70%, almost 70%, all the way down to 17%. Now we're bouncing back up. What we see is TLT moving down to the bottom of this channel. And it's probably going to bounce from here. I don't really see it breaking down even further. If it does bounce from here, then maybe these probabilities are okay, but they're still not realistic. They are priced appropriately, I should say. It's just not, they're not necessarily accurate. So if we get this bounce, we start moving upwards, that's going to relieve some pressure on the market. So even though we had a scare for the CPI and we had this movement downwards, this gap down yesterday, well, we're starting to bounce upwards. And if the TLT can keep moving upwards, then that helps the major indices like the SPY continue to move upwards as well. And we'll see if that's enough for it to break out of this channel, this new channel that we have, and make a new high. But so far, it's not looking great. So if I were to draw a new channel, it would look something like this. Okay, so I'll get rid of the old one since that's not really relevant anymore. And what we see is that, hey, in order to get to the top of this box, we hit that trend line, that previous trend line, uptrending line again, and that is resistance. So we have the top of the box resistance, we have all-time high resistance, we have this trend line resistance. It's going to be a little bit difficult. The good news is that after gapping down below the EMA 20 yesterday, we did trade back above it and even poke our heads above that EMA 8, and we did close a tiny bit above that EMA 8. So if we can carry that momentum forward, we could make it to the top of this box, and then we'll have to see from there whether or not we can break out of the previous all-time high. A lot of things would have to line up for that to happen. For now, we're just looking at this as a chop sideways. And the major force after this week is really going to be probably earnings. We have earnings coming up, but we don't have a lot of economic data as far as I know. Let's take a quick scan. So next Monday, retail sales after the CPI report, it might have some effect. Then we've got building permits, not that relevant to the overall market, at least not at this point in time. Nothing really happening on Wednesday, nothing exciting on Thursday, nothing really happening on Friday. So no major economic news that is on the horizon. So what we do have is political risk with Biden now chiming in on what may or may not happen on interest rates. Powell opening the door in his previous speech to political influence. We had that little scare with the potential escalation in the Middle East and the potential escalation in Russia, Ukraine. And then we have earnings, really. So let's see how active earnings is going to be next week. I'm pretty sure we're going to start with the banks. Let's just look at S&P 500 for now. And we have 3 pages, so we have 60, so not, or 41, not a huge number, but this is more than we've been having. And you can see that many of them are financial. A huge percentage of these are financial. So we are kicking off earnings seasons as usual with a lot of these bank stocks, these financial stocks. We got Netflix as well. So we got some pretty big names. We have a couple of airlines. We got some healthcare showing up. So earnings is going to start to play an important role because we don't have economic news happening. So what we really want to see is how well are our companies doing in the United States? Are they still profitable? Are they still growing? Can they beat their estimates? Do they project good profits going forward? What's been happening lately is they've been adjusting down the projections and then beating them, but there's only so long you can play that game. So at some point, either they really have to beat them, or they can't keep revising down their growth estimates, so or they'll start missing. So either way, we'll get some movement upward or downward. So let's take a quick look at XLF and see how that's looking. So we got this big dip down to the MA50, and we were able to bounce off of it, at least intraday today. We'll see what tomorrow brings. This is probably going to get really active in the next week. And if those financial stocks do very well, it should be able to get back above that EMA 8 and EMA 20, which have now converged at the same point right here. So this one is, I'd put a slightly better chance of them going up than going down. Financial institutions will benefit from higher interest rates, or at least not lowering interest rates. So that's a little bit of a tailwind for them. That may help them bounce back up a little bit. That might help their forward projections if any of the CEOs or CFOs care to comment that, hey, it's looking like we're not getting interest rate cuts as soon as we anticipated. So that's going to help our next quarter or our next 2 or 3 or 4 quarters. If anyone dare to say that, then this could bounce up pretty easily. So XLF will be one to pay attention to. Another sector that's been really active is energies. It's stalled out a little bit, but we did see oil just a few minutes earlier, and that was certainly moving upwards, just like XLE is moving upwards. Once that catches a bid, this could keep on moving. Energies are more like a commodity. Oil for sure is a commodity, and they will tend to trend. They will move in large movements. They tends not to go in small movements. I'll see if that. So we have major movement. This is major trends is what we look at when we look at commodities. We won't care as much about these pullbacks. So MA200. We bounce, chop, and then moving upwards. So this one's demonstrating the nice bull, consolidate, bull pattern right here. And it's looking like we are at the beginning of a new bull pattern in the XLE. Another one that might demonstrate that is GLD. I don't know, I haven't looked at it, but I know GLD has been catching a bid lately, especially with the dollar recently in question, although the dollar is getting stronger now. And we can see along that MA200 up, sideways forever, and then recently breaking upwards. And so this one looks like the beginning of what we call super trends that can happen for a very long time. Let's see what the last time in gold. Well, oh, it does. We do have a nice history from 2005 all the way till 2011, and then a downtrend into 2011 to 2016, and then a sideways trend from 2016 to 2019, then an upward phase that was relatively short for about a year and a half, and then a sideways trend all the way until this year, and we started moving up again. So gold is looking really good as well. So I wouldn't mind doing like a 1% extrinsic value rolling on gold. So what we could do is, what's the best way to show this? Let's go to bar chart maybe and look at GLD. And what we would want to know is the options prices. And if I go out, say roughly 1 month, and I'm looking for calls because this is a super trend to the upwards, or we're expecting it to become a super trend to the upside, what we do is we will look for 1% extrinsic value. So that means we're looking for extrinsic value at about $2.20. And basically the way that we calculate that is if I take this, just call this 220. If I buy a 210 strike, the intrinsic value is the difference between the current price and the strike price. So that would be $10. But since this is trading at 11.38, that would be 11.38 minus my $10. That'd be $1.38 in extrinsic value. So this would work, but this is a little bit less than 1%. And so we might be paying too much if we go with this one. So we want to find one that, although we may not be able to, because the next one is this 215. These don't trade. 211 through 214 are not trading. So the next one we have is 215. So let's call that $5. And this would be $2.63 in extrinsic value. That's a little bit more than 1%. If we call this 220, and of course we have that 22 cents of difference right there as well. So we'd probably go with this one if we wanted to be more conservative, or we would go with 215 if we were a little bit more aggressive, and we could buy that. And what that means is that, let's just say I went more conservative when I bought the 210. That means gold only has to move less than 1%, since we were significantly, 1% would be $2.20. We're at $1.40. So that's 61, so call it 0.6-ish%. Gold only has to move up 0.6% by May 17th in order for us to begin breaking even and making money. So it makes it really easy to make money on these strikes or on these options. And you can see that today alone, it moved 1.93%. So it should be pretty easy if it continues its trend to move 0.6% by May 17th, which is roughly 36-ish days. So that would be an easy way to take advantage of that super trend. And then when we got to May 17th, what we would do is we just sell our 210. And maybe by that time, gold is at 225, 230. And then we could do it again. We could buy the June monthly, and then we could find the 1% extrinsic value again, and then buy it again. As long as it looks like this trend is continuing, we would keep on doing that and just keep on rolling into the next month and the next month and next month, and take advantage of that long-term trend. So that's looking like we are entering a super cycle into gold. You could wait for a pullback, but with a 1% extrinsic value, as long as the trend is intact and you have a meaningful slope to it, then it's not absolutely necessary. You'll squeeze a tiny bit more out of it. In terms of P&L, you'll just squeeze a tiny bit more profit out of it, but at that point, it's just nitpicking. So it's not super necessary. You don't have to play your timing as carefully when you're doing a 1% extrinsic value type of trade. So that's a great way to take advantage of trends, 1% extrinsic value. So S&P 500 though, if we look at we did move down initially to our purple line here and then trade up for the rest of the day. So that was looking like a pretty strong day. If we can get momentum carrying forward, then we will get near, let's see, we could challenge the top of that box in the next few days. And it wouldn't be too surprising. Chopping up and down inside the box is normal. So that wouldn't be surprising at all. What we would want to see then is what happens as we get to the top of the box. So for now, there's not a lot for us to do or to anticipate, except that, hey, maybe we'll have a small, tiny directional move to the top of this box. And then will be wait and see. So either we want to try to play that tiny move upwards, in which case the best way would be day trading, or you would want to look for a high reward to risk ratio trade right here in order to take advantage of that small movement. You wouldn't want to be doing a lot of time value, because your ability to get that high reward risk ratio would be very low. You would basically, we would want a 1 day expiration to 1 week expiration in order to get that. But then you'd have to be willing to lose your entire investment amount if you just went for that tiny short event. So if I go over here, let's go back to SPY. I could do a tomorrow expiration. And I say, okay, well, if we could get to the top of this box, or just say maybe halfway to the top of the box, we'll be at a little above 520. So if I buy the 520 strike for tomorrow, then at this moment, who knows, we're open tomorrow morning. If we stay flat into the morning, then I could get that for $1.08, which would mean to break even by the end of tomorrow, I would need this to be 521.08. And I was thinking that maybe it could at the very least get to 520. So that's not the right one to choose. So I would want to say maybe 518. If I go to 518, well, then I would need it to go to 520.11, and that's still not ideal. So then I need to start moving upwards. Then they start to get more expensive, and if I'm willing to let it go zero, I probably don't want to risk this much. So far it's not looking great. And so we would, because the upward movement just isn't large enough. If I was saying, hey, I think we could get to the top, or maybe to the top of this bar, like the open of this huge down bar right here, so to 523.46 tomorrow, then it would be more worthwhile, because then I could go and say, okay, I'll buy that 520, I'll break even as long as it gets to 521.08, but I believe it's going to 523, so I can make $2 right there on my $1.08 investment. So that's a 300% growth, 200% return. Yes, 200% return. So that's a reasonably large reward to risk ratio, and that might be okay. That might be worth it. So I just have to see, do we believe that it could get to that high, almost to the top of the box in a single day? It's possible, but I don't have any real catalyst or particularly convincing reason for me to believe that it is going to happen imminently tomorrow. We do have an economic report, if I remember correctly. Consumer sentiment, yeah, that by itself is probably not going to do it. So are we going to see a large amount of buying coming into the weekend and taking risk over the weekend? Probably not. If I was an institutional trader, I wouldn't be doing that. So I'd probably just skip trying to do this. So the other possibilities is, well, what if we get to the top of the box by the end of the week? So that would be 525. So we would allow ourselves another week over here. So we'd go to 419. And if we bought that same 518 call, then that would be 422.7. And that would, and I believe it'd go to 525, that would give me $2.30 in room, but then I don't have a high reward to risk ratio trade. It would be a $2.30 versus, if I'm willing to let this go to zero, $4.70. That's the opposite of what I want. So it looks like that there's just simply not enough movement. We're not expecting enough movement in order for us to try to take advantage of this baby move upwards. Excuse me. So that would be something that I would pass on. I wouldn't be trying to do this unless I was day trading. If I was day trading, that'd be a different story, because then I would go in, I'd watch these purple lines, I'd watch how they're reacting to the purple lines, how they're reacting to VWAP, just like we do mostly in the morning analyses. So you say, hey, if it goes here and it turns around, then that might be a good trade. Or if it comes just like this morning, if it came down here and we find support right here and it turns around, then that might be a good trade. And that would have been a very profitable day trade. So unless you're day trading it, I wouldn't be trying to capture this move right here. Okay, if we look at QQQ, pretty much the same story, except it's looking a little bit better than that S&P 500 because at least it found support at the MA50. It is underperforming the S&P 500, but it is in a stronger position in this particular moment, if that makes sense. So we're definitely in this chopping range, but we found support at the MA50 and we're moving up, and actually we're pretty close to the top of that box already. So we could see it challenge this top sooner than we see the QQQ, or sorry, the SPY challenge it. And then we'll get to advanced preview of whether or not it can break up or it falls back down. We would expect QQQ to lead SPY on the way up anyways. So if this breaks out of its box, then there's a good chance that the S&P can break out of its box as well. So this is an interesting move on the day because if we include the gap, this bar is almost as large as this big red bar. So that's a lot of enthusiasm. And we already have average volume, which means after we get the dark pool stuff, we might get a little bit above average volume. So this is actually a pretty significant bar in the QQQ. It does look like there is some money coming back potentially into tech. Yeah, very similar to what we saw in QQQ. A little bit weaker than QQQ. Let's look at XLC. Okay, not as convincing in the XLC, but XLC is much stronger than the QQQ. It only came and touched its EMA 20 and bounced right back up. This is even stronger than the S&P. So, and let's look at semiconductors. Same thing. It only came down to its EMA 20, chopped sideways for a while, and it's starting to move up. You can see we're starting to get momentum potentially to the upside because we bounced and we have upward sloping of the EMA 8 and the EMA 20. Obviously, the EMA 8 slope is going to be a little bit sharper than the EMA 20 because it's a shorter time period, but that does allow us the ability to start separating. So instead of converging together like this, they're starting to separate out a little bit. It's a little early to make the conclusion, but at least it's happening. So it looks like money is creeping back into the tech sector. So if we wanted to take a baby amount of risk to the long side, so SPY, what should we be doing? Well, it's chopping sideways. We concluded that we broke through our slope, our uptrend line, and we started chopping sideways. So when we're chopping sideways, if we're limiting ourselves to single option trades, then we can only go directional. And if it's hard to go directional when the market is chopping sideways, that means you want the absolute strongest stocks to go on the way up and the absolute worst stocks or weakest stocks if you're going to point downwards. And wherever you're seeing money move into or out of, then that's where you would start to allocate your money as well. Since we can pretty clearly identify that it looks like at least the very beginning phases of money moving back into QQQ and into the tech sectors, then we could make a baby trade in the tech side and take some risk to the upside. And maybe we'll want to balance that out, in which case we could make it a larger risk as long as we have balance to the downside. Or we could just say, hey, we'll appropriately allocate risk size to this trade so that we're not leaning super bullish. It's just we're still, for the most part, neutral. We're just baby bullish because of our trade. That would be okay and appropriate also. So I'm probably going to be looking for maybe some tech sector longs to the upside to do some short-term trades or a baby allocation trade to the upside, unless I find a good downside trade as well. Or if we can find where money is moving out of. Let me see if I have my sectors. Let's just get a quick sector visual. And we'll shrink that down to 1 day. Let's go in the last. So what's this green one? This green one is XLK. Okay, so we identified the top one already just from looking at QQQ, and money is coming out of this purple one, this dark purple one, which is real estate. So yeah, real estate interest rate sensitive. If rates are going to be higher longer, then real estate is going to have some difficulty. We do have some real estate related reports coming up next week, though. We saw that. Mortgage rate, building permits. Right? So we may want to avoid real estate. And in that case, what the heck? Is this my, yeah. Okay. So maybe this one, XLF. Well, financials looks like they're bouncing and we're going into earnings, so we will want to avoid that one as well. XLU. Let's take a look at XLU. Okay, so if money starts leaving XLU and coming down, we could take a look at some of those, or actually more realistically, if we wanted a better hedge, now that I think about it, we would want to stick within XLK. So we identify a strong one in XLK and a weak one in XLK. That way, if something happens to the entire sector, both stocks move in the same direction and we lose money on one and we make money on the other one, but we'll make money on, if it's directional, we'll make money faster than we lose money. So that would be the better pair. We would find a long and a short all in XLK or XLC or the semiconductor space. So that's what I'll be looking for today. So a little heads up, don't be surprised if you see a couple of tech names being recommended today. Okay, I think that's going to be it for today. We have got a pretty good and thorough view. Overall, we're just saying, hey, everything is chopping sideways. It looks like we're going to get at least another couple of days of chop. And then earnings might start to change that story, although that's going to be mostly in XLF in the next week. So is financials enough to drag the entire market upwards? Well, if we look at a heat map, let's take a look at a heat map. Where's my, here we go. If we look at financials, see, this is the financials square, and that makes up about, I would call about a 1/8, roughly 1/8 of the entire index. So financials, will that by itself be able to bring the entire index up? Probably not. But if the enthusiasm spills over into other sectors, then yeah, it could happen. So I wouldn't count on it necessarily just by itself to pull us above and break us out of this chop, but it could help us move towards the top of the box or maybe increase the size of the box a little bit. So that's how we're starting to look over the next week. Today is Thursday, so we won't have the aftermarket session on Friday, but we will have the weekly market review on Sunday, and we'll go over this even more, but this is a preview of what we can expect over the next week. All right, thank you guys. Have a wonderful rest of your day, and I will see you tomorrow morning.